if you're a regular listener to the monthly market commentary and you have a very good memory, you'll know that last March I had named one of these points dealing with this same kind of saying, March is in like a lion, out like a lamb. Well, this time I'm naming in like a lion and out like a tiger, because it didn't get really any better. It wasn't a great month in the month of March. In fact, we saw a pullback in the markets, but I won't spoil all that. Tim, talk to us a little bit about what happened in March, just big picture. What did the markets do? And then give us a little context of why.
Yeah, so if we think it's, or focus on maybe 4 big indices, 3 equities, 1 fixed. So the S&P was off about 5% in March, and we're still in the seasonally strong period for equities. And so, not only were things down a lot, they were down during a time of year when you don't necessarily expect that. And then if you look overseas from an equities point of view, right, developed equities were off 10%, and emerging market equities were off 13%. And then the Bloomberg aggregate, which is a high quality fixed income index, was off about 2%. So there was kind of nowhere to hide, and the rest of the world did even worse and much worse in the U.S. And for the big reason being that we've all talked about and paid attention to is the war with Iran, which got going, call it February 28th, March 1st, and did a couple things. Probably the most important thing, and not to be dismissive of the conflict or the loss of life or the soldiers and military folks that are still in harm's way, but it drove the price of oil, at least looking at West Texas, from $67 a barrel to $114 at one point. And that big jump in oil caused a couple big concerns, and I apologize if I'm sort of stating the obvious. One was a big spike in the price of oil here and around the world would just slow economic growth because it's a big drag on profitability and input costs go up. And at the same time, it would drive inflation higher, which would complicate the picture for central banks around the world, particularly here at home. And then if you think about the rest of the world and the oil that's kind of coming out of that part of the world, as we know, most of it goes through the Strait of Hormuz, which the Iranians apparently still control today. 20 to 30% of all the oil that moves around the world on a daily basis goes through that strait. Most of that oil goes to Asia. Really none of it comes to the U.S. And so because the U.S. is a net energy exporter, the world's largest producer of crude and natural gas, on balance, I think we suffered a lot less because of our energy profile, where countries like Korea and China have to import a tremendous amount of oil to keep the lights on. And so I think that's why the rest of the world struggled more than we did. And then the other point being, as we've talked about, we're sort of the cleanest, dirtiest shirt in the hamper, the best house still in the global neighborhood. So when the world gets unpleasant, people come to the U.S. And so capital, if it's going to go anywhere during periods of distress, will come on balance to U.S. equities, bonds, and the dollar, and that will prop our markets up a bit more than the rest of the world. And so ultimately, I think it was all about the conflict, what that meant for oil, and what oil might mean for global growth and inflation.
That's a lot.
Yeah. Sorry.
That's a lot. No, it's fine. That's exactly why we have you here. Boiling that down, I mean, the bottom line is you get into an international conflict, call it a war, call it whatever you want. It's going to change things in our economy. And when you're dealing with a country that affects the world's energy supply and oil like that, you're going to get a knee-jerk kind of snap reaction. Yeah. And we saw that. And not only that, but Americans are feeling it at the pump. Very much so. I've got a 16-year-old son at home that I require pays for all of his own gas. And so he just got his license in January. And so he had a couple of months where he got used to paying one price and had budgeted around said price. And by the end of March, he had less than none money. He was in the red because his budget had changed dramatically. And it's a small example of the way that you and I feel it. And then, of course, you've got the pain of Wall Street kind of reacting to it as well. And we've talked about this a lot on the monthly market commentary, Tim, but at the end of the day, what the markets don't like is the unknown. They do not like when they don't have a clear vision of where things are going to go. It's a lot easier to look at the forecasting and balance sheet of a publicly traded company and get an idea of where they're headed. It's much harder when you get into a conflict with Iran to understand exactly how long it's going to last and how it's going to play out. And as we stand today, this is the monthly market commentary based on March, but here we sit in early April.
Yeah.
And we've got big news around a ceasefire, but now already, there's some uncertainty on if that's actually going to
To
play
hold
out.
or not, yeah, and whether or not the
so
strait will reopen.
Massive uncertainty.
For sure.
I guess
And
is what
so
I'm
you're
trying
right,
to say.
people are going to move to the sidelines and de-risk, and that'll be reflected in equity prices and bond prices. But at the same time, you have the risk of jinxing it. The S&P is up 4 or 5% month to date, and overseas markets have reclaimed a lot of what they lost last month, as it looks like maybe things are winding down. So it's hard not to get whipsawed by these macro events, which again, as you know, you preach it and you're right. You think about plans, long-term goals, diversified portfolios, and that's the stuff that kind of helps you navigate these periods of massive uncertainty, I think.
Yeah, well, that's a great segue into our next point, which is that look forward.
Yeah.
And as we look forward, kind of present, but through the rest of April here, I'm just going to name this point: the glass is half full.
Yeah.
Because at the end of the day, you and I have talked about this too, Tim. We're both optimists by nature. I don't believe that if you don't believe in the long-term validity of our free market system and our financial markets, you shouldn't even be in them today, because that's not investing, that's gambling. And so it requires, if you think about it, it requires a certain amount of optimism when you put your money in harm's way by going into any sort of investment, whether that's in your son's startup, hot dog stand on the corner, or it's in a massive publicly traded company. And so, but I don't want to just say it.
Yeah.
I would love to quantify that a little bit. So when we look at it from a quantifiable perspective, what are some of the reasons that the listeners should be optimistic moving forward in spite of this uncertainty?
Yeah, no, and I'm a glass half. I like to joke, even though I grew up in New Jersey, I'm an optimist. I'm with you, and it can get hard sometimes.
The unicorn of Jersey.
What's that?
The unicorn of Jersey.
The unicorn. Yeah, I'm the one.
Jersey tried to make me a pessimist, and they couldn't. You're a true optimist if you can get through Jersey and come out the other side an optimist.
See, you understand. No, I think there are a couple things you can lean on, and again, not to make light of what's going on in the Middle East, but think about where we were before this all happened. I mean, there were some concerns around, say, private credit, which we can talk about, valuation. There's always things to be worried about, but the economy is growing 2% plus, productivity was growing 2% plus. You've got the ongoing AI build out from a data center and a chips and an energy infrastructure point of view. By most accounts, almost $1 trillion in CapEx this year. You've got the One Big Beautiful Bill Act, which is very stimulative for corporate and consumer spending. By most accounts, tax refunds this year for the average American taxpayer up 11% year on year. So that's money in people's pockets to spend. And then maybe most importantly, you've got earnings growth that for the Q1 period, which we're going to start hearing from companies on Q1 in a couple of days, should be around 13%, which would be the sixth consecutive quarter of double-digit earnings growth. And for the year, folks in our business think earnings will grow about 17% for the S&P 500, which is just a remarkable rate of growth at this point in the economic cycle. So again, there's always sort of points of concern, negatives, both independent of these macro shocks like we're living through. But if you think about where we were before March 1st, I'd argue that there was a lot more good news out there than bad. And then finally, the other two things that are sort of in the background a little bit, maybe one in the background, one in the foreground, is by most accounts, companies are very well capitalized, north of $4 trillion in corporate balance sheets if you exclude the banking sector. And we've got Artemis 2 up there. What those folks are doing is just absolutely incredible to me. If memory serves, that's a SpaceX rocket, I believe, and Elon Musk is looking to take SpaceX public this year at a valuation north of $1 trillion. And in the first quarter, you saw more $10 billion plus deals done than at any other quarter in the U.S. economy's history, which is a long-winded way of saying there's capital to be put to work, almost revolutionary technology to build out. And you've got this kind of budding animal spirits dynamic going on, which has historically been a huge tailwind for risk assets in the market. So I think we'll get through this war. I'm sure there's nothing about the U.S. economy today that's different in a way relative to pre-war that would make me, to your point, long-term bearish on it. And I think there are a couple things that could really push the economy higher into year end, including this sort of opening up of M&A and initial public offering activity that's likely on the come.
Yeah. I think that's really well said. And I would just summarize it by saying essentially the fundamentals are very strong. We just are, we're faced with a little bit of turmoil, a little bit of headwind, but it is a marathon, not a sprint. This is you're 20 miles into the race. Fundamentally, everything feels good, which I've only run one marathon in my entire life. And I can
good
tell
for you. That's one more than I did.
At mile 20, I didn't feel like any of my fundamentals were strong. But we've got a lot of really positive things going on. There's just a lot of white noise right now that are causing some short-term pain, tumultuous reactions, things of that nature. So love going back to the fundamentals, because that's why you invest in the first place. You're not investing to try to time out economic uncertainties and try to time out the world economy relative to when things are going to any number of things, whether it's a war that starts with involving us, a war that's not our own soil or doesn't involve our country, or it's a new leader somewhere else in the country. Not the point of trying to get into these long-term markets. And so love the fundamentals. It's absolutely a reason to be optimistic, and it's going to be very interesting. I don't know how much you've studied the what SpaceX is doing and why, because I've always been, Tim, and I don't want to completely derail us here, but I do think it's really interesting, and so I'll take 30 seconds to, listeners, you can indulge me on this.
Yeah, of course.
Why, I've always, why is Elon so obsessed with, the moon and with Mars?
Yep.
You dig a little bit, and what you realize is if they dig a little bit up there, a lot of the natural resources that we're after down here exist up there. It's just how in the world do we get there, and then how do we get them back efficiently? Yeah. And recently, I've been doing some, listening of podcasts and studying of this because I'm just very curious. And I won't get into all the fine details here, but it is a lot more realistic than I thought it was, based on tech that's already been invented, of how they would ever drill or mine on the moon to get resources back to Earth that we need. So there you go. That's why they're so interested in the moon. It's not just to be there and plant a flag.
It's my understanding, the NASA sort of timetable is this mission, one more, and then a moon landing before the president's term is up. And as someone at NASA said, we're not going to collect rocks, we're going to build a base, and that base apparently is a jumping off point for Mars. And this stuff is just absolutely
but it's also incredible. A jumping off point for robots to start mining, to send back raw materials to Earth, including things like gold that exist on the moon that we can use down here. So
the other thing,
maybe Trump isn't going to go after Greenland anymore, because now he's going to go after the moon.
And if you think about what's going on right now from a purely sort of economic, geopolitical point of view, agree or disagree with where we are with Iran negotiating a ceasefire or not ceasefire. We've done this. I'm sure other nations are helping in the background, set aside Israel and what they're doing, including European nations. But hegemony. I always struggle to pronounce hegemony. Right?
Yeah,
I think that's
either,
right.
Tomato,
either way, right? If anything, as we come out the other side of this, the U.S. economy is more important. The U.S. is more important because the U.S. is doing things which it could have always done on its own anyway, but has decided to more or less do on its own in the Western Hemisphere and the Middle East. That the distance the gap that we have opened up between, I think, our friends and our foes over the last, call it 30 days or call it the last 4 months with Venezuela, is just astounding to me. Yeah. I mean, we're more, like or dislike the U.S., we're more important and more powerful than we were 30 days. I honestly believe that. I mean, what we're able to do is just incredible.
Well, we own the moon now.
Yeah, and then you have this. It's just keep going. It's kind of remarkable.
Trump's going to try to plant a flag on that moon and say it's ours. So
why not?
Yeah.
Why not? Sorry, I'm bad.
And that's not a political statement, by the way. I don't care if you like the guy or hate the guy. I'm just. We all know he all presidents have their things. And they have their isms and they have their idiosyncrasies and all that kind of stuff. So, The data point we're discussing, I'm calling hitting the reset button, and I want to hedge it by saying this, or preface it, I guess, by saying this. When you're hitting the reset button, it could be for good or for bad, right? And sometimes when you hit the reset button, it causes bad things to happen. I think of my brain immediately goes back to when I was in college, we were still on discs, right? If you wanted to save your paper, it was on a disc. It wasn't inside the computer. It wasn't on, the storage on the computer. And I remember once a final paper that I had to do. My major was youth ministry, so most of my finals were not tests; they were papers. Mm-hmm. And so in any given semester, I had 50, 60, 70 pages of papers due at the end of the semester for our finals. I got really good at writing papers. Good relative to finished. Not quality of work, but just work done.
Quantity.
And one of my papers, a 26-page paper, didn't save. And,
man, that's
sometimes the reset button is really bad, I guess is what I'm trying to say. Sometimes it's really good.
Yeah.
And so we're calling this hitting the reset button, and because we're optimists, I think this is actually a positive. So what am I talking about with this reset button? What's going on?
So you're talking about a reset in terms of valuation, for sure, and we could probably peel that onion even a little bit more, but at a high level, so if you go back to pre-March 1st, concerns around private credit, AI build out, maybe there's money being wasted, valuation, still the markets had done well again last year, not 20%, but close. And so when the S&P falls 8-9%, which it did peak to trough, it never got to 10, some of the other indices did, and earnings came through for Q4 in fantastic fashion, low double-digit growth. Rising earnings, falling stock prices sort of meet in the middle, and you get a price-to-earnings ratio. The S&P was at 23 times before this period of volatility to the downside. It's at 19 and change now. Still expensive over a very long period of time, not really expensive over the last 10 years or so. So if there is an upside to a pullback, it's usually a resetting evaluation, which sets the floor for the next move up. But it also then, the other sort of the second derivative would be what it does to sentiment. As stocks go down, people get upset, they get bearish, it's understandable. And so the one investor sentiment survey we like to monitor more than any of the others is the American Association of Individual Investors, or AAII sentiment survey. Historically, the bearish average reading in that survey is 31%, meaning 31% of survey respondents think markets will be lower over the next 6 months. A couple of weeks ago, it hit 51%. Not the highest of all time, but not that far removed. So resetting expectations, resetting valuation is not a pleasant process, but it's usually what tees you up for the next move higher. So that's how I would think about that.
It's funny in the stock market world because everybody likes a good deal. Everybody does. There's nobody that thinks, sees a product that they want on Amazon or at Target and goes, you know what? I really wish I could pay more for that. It's always the other way around. We like a good deal, and if something's priced at $60 and it goes on sale for $30, we feel really, really good about it. And it represents opportunity for us. And resetting evaluations, especially in some of these massive companies, or the largest of companies like NVIDIA, great opportunity.
Yeah, we don't talk individual stocks typically, but that company is trading at 22 times forward earnings, so not that far removed from the broader market. And I haven't looked at its last earnings report in a bit, but I'm pretty sure it's not growing earnings at 22%. I mean, it's incredible. So, it's really interesting what's going on underneath the surface for sure.
Yeah, definitely some opportunity out there when we start to hit the reset button. Things kind of clean out a little bit too. And things get a little bit kind of neater on the back end and cleaner on the back end. And so bottom line is just want to acknowledge the fact that the short-term, volatility can always cause a little bit of fear. And I don't want to downplay that, Tim, but I do want to end this by basically reminding the listeners that if you're a client of Fiat, there's multiple things that we're doing in the kind of foundational level of planning, in the concept level of planning that are built just for this. And it's not market timing stuff. It's things like making sure we've got money that's built to be spent and put back into your life in the next couple of years. We've got another bucket of money that's built for that kind of that middle ground. And then we do have that longer term equity position. And long-term equity positions should never be affected by short-term tumultuous markets, no matter what is causing that to happen. And so timing, we build out time buckets. That's one of the ways that we do it. We diversify outside of just equities. That's another way that we do it. We diversify on an institutional level. There's just all kinds of additional layers of diversification, time, investment, tax diversification that come in that bring in extra layers of security for people, Tim, that aren't in their accumulation years anymore, like I am, who can withstand this, because I don't need that money today. I don't need it tomorrow. It wasn't for that anyway. And so it's just a paper loss to me today. But there are people that's not true. They're spending this money. But when I say this money, that's not their equity money. We find ways to build financial plans that can withstand any sort of short-term market pullback. And so we have built for this. Just because we don't tend to talk about it and make a huge deal about it when it's going on is simply because it doesn't surprise us and we plan for it. And so don't take our lack of fear or our lack of raising red flags as anything other than we were ready for it. Not surprising.
Well said. Well said.
So, Tim, I always appreciate your time. It's always good to see you.
Good to see you.
And hopefully by the next time we talk, our optimism continues to play off in the short term. And even if it doesn't matter because we plan for it anyway. But more importantly, it's hopefully 80 degrees outside. But we talk in May.
Fingers crossed. Enjoy the Masters. It's always good being with you, Brad. Look forward to catching up with you next month.
All right. Thanks, Tim. Thanks, everybody, for joining us for this month's monthly market commentary. Like I said, I'm Brad Gotto. This is Tim Holland. If you want to follow along or learn anything more about Fiat Wealth Management, you can find all of that information at our website. That's fiatwm.com. We will see all of you next month.